Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Historic day here on January 22nd. Swizz, along with EYT, she of SoFi, Dan Nathan of the Risk Reversal Media Group. By the way, before we started the show today, for all you rock aficionados, I brought up the song 30 Days in the Hole, and I asked Elizabeth and or Dan if they knew who sang it. They did not. That, of course, the great Humble Pie, Peter Frampton, one of the founding members. Peter Frampton, obviously, just inducted long overdue into the Rock and Roll Hall of Fame, along with like Cher.
Yeah,
okay.
Some of us have to eat some humble pie here.
I see what you did there.
On the market call, we were talking about Netflix. We were previewing it into the print, 8.5% implied move. We're going to spend more. Pie. It's a thing. People do it in the markets. People do it in sports, Liz, don't they? They eat some humble pie.
Yeah.
Let's talk with Liz here. She's right in the studio with me, Guy Adami.
Yeah, I see her.
Guy was unable to be here today, just really quickly, because of a bunch of needles put in his back. We're not going to say what for. I'm kind of
I got issues. I got back pain. What am I tell you?
Liz, let's talk. A lot of green on the screen here on my FactSet screen. Predominantly in the tech space. How you feeling here on the markets in general? Give us your vibe check.
Yeah, I mean, well, we'll get into my note later, but basically the title of it is The Buyers Are Back in Town. So, here we are. We're day 2 of a new administration. And I think we've just been through a couple of phases of this administration and the anticipation thereof. And now we're back into this phase where we're going to see a little bit more broadening out again. And we see a market that has buyers in it looking at different sectors besides just mega cap tech, and optimistic again about a pro-growth deregulatory environment. And I think that's okay to be optimistic about it. And I think that there is, a shift in regime. There's a shift in the mindset, and that's okay too. But we still don't have a ton of clarity. And the biggest thing, and I talked about this yesterday on CNBC, the biggest thing that I would be watching for in this first quarter, maybe even this first half, is that we don't know as much about tariffs yet that I think we hope to. Last time when this happened, even when we made tariff announcements, there were then retaliatory tariff announcements that occurred. And the retaliatory tariff announcements hurt our market quite a bit, actually hurt our market more than us announcing tariffs on other people. So we have to still wait for all of that to shake out. But as it stands right now, the other thing about this that was positive is that it came at a time, the inauguration, this shift in regime came at a time when the market was in already a positive place, in the sense of the 10-year yield had fallen 20 basis points. We had 2 inflation prints that didn't scare anybody off. So we were in a more stable place than we were mid-December, and this just added fuel to that.
No doubt. Of course, buyers are back in town as opposed to the boys are back in town. That song, I believe, was 1976, Thin Lizzy. But I digress. They are not in the Rock and Roll Hall of Fame, nor should they be. Let's go to the Rich Ross note, because I think you're going to see more and more people sort of opine about this and say, you know what, yields are not the headwinds that everybody seemed to think, and we're going to look past it. The market's just going to continue to do the grind. And look, by the way, that course of action or that mindset has been spot on. It's not an indictment. I'm not downplaying it at all. But my point is, I think, as the market continues to do its thing, I think more and more people are going to sort of come to that way of thinking. I am not one of those people, by the way. And if you listen to what Jamie Dimon said earlier, I think it was this morning with Andrew Ross Sorkin from Davos, on all the metrics that he looks at, the market just continually gets more expensive. That can be mitigated to a certain extent by earnings, Dan, but I don't think it's going to be.
Well, again, if you just look at just what we've seen over the last few weeks for Q4 earnings and the guidance, they're coming up better than expected. And that's something that's kind of buoyed the market. You made the point on a couple of occasions over the last 2 weeks or so, a little bit of a sell-off, kind of filling in a little bit of that gap, right, from the post-earnings sort of enthusiasm, was probably a pretty good setup for lots of stocks, in the market that were digesting some of those gains in the prior 2 months. And here's that QQQ Q. You see it, the NASDAQ 100. It's not yet made a new high, right? So we saw that in the S&P 500. Again, that doesn't mean a whole heck of a lot, because as we get later into the earnings cycle, you might see some stocks that have been running with some of their peers or some of their suppliers or some of their customers or whatever it is. You might see that expectation get a little bit too high relative to the performance, if that makes some sense to you, Guy. And I just want to make one thing, going back to our old friend Rich Ross's piece. He used to come on the program on Fast Money a bunch. He's a technician. I like this last point. When the dust settles, we're going right back to those strong secular trends, big cash piles and big moats, Liz. So, and basically big tech. And so it was kind of an idea that we heard again and again, that this is sort of the safety trade, but it's also the offense trade.
Yes, but I think, well, if you looked at what happened yesterday, if you just looked at intraday sector performance yesterday, by the end of the day, I believe the best performing sector was utilities and the second best was industrials, and they were in tight range of each other. So when you look at just what's happened, even over the last week, we knew inauguration was coming. We knew some of this stuff was going to change. And it was actually a rotation back into things like industrials, materials, financials. And interestingly enough, financials is one of the sectors that tends to do the best in the first year of a new presidential term. So I think that investors are going to continue, of course, owning some of this big tech stuff. And when you look at the Qs, if we want to bring that chart back up, actually, when you look at the Qs, over about a 1 month period, they've kind of moved sideways, choppy and sideways. But the reality of what happened in December, mid to late December, is that tech broadly actually deteriorated, but the big cap names did well. So it looked like the sector did okay, but under the surface, it actually deteriorated. So this hasn't been a clear tech is winning sort of play. Tech is doing better today than the sectors that I mentioned before, but I think we're going to continue seeing this. And I talked about that in my note. We're going to continue seeing this back and forth, this whiplash, because we're not yet sure how all of this is going to shake out and really how it's going to affect the business environment at large.
Excellent points. And, I made a comment about Jamie Dimon earlier, and without seeing things, it's hard to sort of ascertain what he's talking about. But we put together, we being the crack staff here at Risk Reversal Media, led by the great Amanda Diaz, if you could show this next slide, which suggests as bullish as things were in January of 2009, vis-a-vis these 8 or 9 different indicators, that's how bearish things are right now. So when I mention these things, or Dan or Elizabeth or anybody, Doug Cass, there is context for this. And, you can look at the list. The 98th percentile is the lowest reading here, and that's the CAPE ratio, which, by the way, I think, Dan, is approaching 38. I think the all-time high was 44, and I think the mean for that is 17. But everything else is either in the 99th or 100 percentile of basically where we've ever been. And that obviously suggests that things are extraordinarily expensive. It's not just one, it's almost literally everything you can sort of find that measures, that measures the extent that the markets run without basically the supporting fundamentals. And that obviously is juxtaposed with January of 2009, where everything was on the flip side of that coin. So I think you remember the subsequent rally we saw from that point onward. I guess it's fair to say, well, if that's what we saw back then, are we setting up for a similar move the other way now, given all these indicators?
Yeah. And so what's interesting to me is like the sentiment as we had it in January of 2009 or late 2008 could not have been worse. We just lost some of the biggest financial institutions in the world. I think the world economy was bracing for a sort of rolling sort of economic sort of disaster, right? A rolling kind of bear market in almost every risk asset, as rates went to zero, fiscal stimulus went up, and at the end of the day, that bearishness about the economy and risk assets in general, and you look at those levels in which it hit on a, now on a relative basis, that was one of the most epic rallies you will ever see in the market. It didn't really look back for a few years. And now you look where we are. I guess the question, Liz, that I would have, you look at these really, really extended valuation things. You look at sentiment, which is pretty positive here, with, okay, we have unemployment down to 3%, or above 4%, actually down, up from 3.5%. You have inflation down, you have GDP up, you have all these things where what derails it here? Because it's not going to be just valuation alone. It's not going to just be over exuberant enthusiasm about risk assets. There kind of has to be some sort of match that starts the fire, if you will.
Yeah, well, what we outlined in the 2025 outlook, there's a section called "What Could Go Wrong," right? So we outlined the strengths and the pillars of strength that we saw leading into 2025, but then the things that could go wrong. Chief among them, which hasn't happened after we watched the inflation prints of December, but chief among them being the risk of reheating inflation, the Fed having to turn hawkish, not just staying pat, but actually having to turn hawkish to control inflation, and then yields spiking again. I mean, it wasn't so long ago, just a little over a week, where we had the 10-year yield creeping toward 5%, and stocks did not like that. So I don't think that the 10-year yield is out of this story. I think that's one of the big risks, or one of the matches that could light that fire. The other thing that is a little bit less tangible and hard to measure, but it was indicative on the last slide, is that sentiment could just get overdone. Speculation overheats. And I talk about this a lot. I am not calling for a financial crisis. I want to make that very clear. But most financial crises are at least preceded by some kind of excessive risk taking or excessive speculation somewhere in financial markets. So this sentiment, if it continues going, I think pretty quickly we're going to hear a lot more of rhetoric around, have we gone too far too fast? Are we getting towards that exuberant stage? Is this how bull markets die? We had that coming into December of last year, and then we know that there was a mini correction that occurred at that time. So again, I think we're going to be living through this sort of choppy and sideways market. The biggest risk here is that so many investors get sucked in to cycles like this. And then you end up with everybody positioned for only upside. And that's where people get caught flat-footed. So one of the points that I also made in my note today is that you have to be diversified here. This is a new environment. This is a new year. This is a new administration. You can't assume that this administration is going to have the same exact effect on the market that the last time they were in office did. So you have to be diversified, not just from a risk control standpoint, but even from an opportunity standpoint.
We have a question from Chris L., which, is sort of out of left field, but not necessarily, because it's something we brought up. He's asking about the rumblings, Elizabeth, of a rate hike in Japan. And if memory serves, I think the date that they're talking about is the same day as, I think, Tesla earnings and hearing some Fed speak. So it's going to be interesting to see what transpires on the back of that. If they're currency strengthens on the back of that. Clearly, yields have been moving up. I mean, they have a bit of a problem. Again, our market doesn't seem to care, but I think, Chris L., there are some merit to that. So let's go to Elizabeth's note. From downside fears to upside surprises, reminiscent of a title of a song, From Small Things, Baby, Big Things One Day Come. I believe that is either Dave Edmunds or Dave Edmunds with Nick Lowe as part of Rockpile. I'm sure Doug will let me know, but please, Elizabeth.
That's definitely not why we titled this chart.
No, I
can assure you, Mario, and I have no idea what
Mario does not know this. You do not know this. Yes, please.
And by the way, the next Bank of Japan meeting is on January 24th.
That's
when that decision.
That's this week.
That's correct.
Oh,
and yes, a rate hike is expected.
Yeah.
Okay, so to this note, we talk about, or at least we hear about, a put call ratio all the time. This is what that's showing. And the buyers are back in town theme is what this is all about. So how do we measure that the buyers are back in town? Because it's not that straightforward. If you look at something like the AAII bullish to bearish index, it actually shows that people are pretty bearish. But then you look at something like this that's measuring activity in the market on a day-to-day basis, and you've got this magenta line, which is measuring the put call ratio. As that magenta line falls, it means people are buying more calls than puts, which means they expect the market to go up more than they are buying protection for the downside. The blue line is also very interesting. This is what's called the CBOE Skew index. And basically it's a measure of tail risk. So as that blue line rises, it means that people expect more tail risk. Now, the natural thing that you might hear me say there is that isn't tail risk bad? Well, what this is showing us is the relationship between the two. So if people are buying more calls, they're expecting upside. That means they're actually expecting tail risk on the upside. So there was a slide earlier that talked about the elites are not expecting the bubble to pop or something like that. No, because apparently people are expecting it to just continue growing, and that the surprise we're going to get is tail risk on the upside. So this is an important exercise to go through as investors, to realize that when we talk about risk and we talk about volatility, it counts on both sides. And investors are going to position themselves a certain way. And that's why I mentioned before, one of the big risks that you run into at a time when sentiment is so positive is that everybody is positioned a certain way. Everybody is positioned for the market to continue rising. So if and when it does reverse course, it exacerbates that move because all the positioning was off sides. So this is showing, and this is a short-term view of it, but this is showing that that's where we've moved even just in the last week.
And so let me give you a short example. And this is a single stock, right? So if I'm looking at NVIDIA, which is obviously one of the stocks that folks, most closely tie to this secular shift of generative AI, right? So let's look out to February expiration. That's about a month from now. It's February 21st. The stock is trading at about $147. If I were to look to a $10 out of the money call in February expiration. Okay. So that would be the 157 strike call. It's basically offered at $3. All right. So if you were to buy that call, you would need basically the strike price plus the call premium to break even on February expiration. That gets you to about $160. Now, if I look $10 out of the money to the downside to a February 137 put. Okay. If I look at that, I see that offered at about $2.30. So the call $10 out of the money a month out is basically 70 cents more than the put that's $10 out of the money. So the skew is to the calls. It's telling you that there is more demand for calls than there are for puts. It's just speaking to a level of complacency. And I just wanted to kind of break that down a little bit because, Guy, this is something that we have seen in names like NVIDIA and Tesla and a handful of other, really hot stocks over the last few years. Usually when you get that sort of relationship, it doesn't end particularly well.
No, exactly. And Doug Cass has been pointing that as well. We're going back and forth with him now. So, we don't rehearse these things, but he had similar thoughts today that we're having right now. And, we've talked about individual stocks having those types of skews. And, when it ends, obviously people are unprepared for the other side of the equation and you're getting towards those levels. But one thing I find myself thinking about with this new administration, and I'm not sure if anybody can answer the question between you and Elizabeth, but how often have sectors beat the index during the first year of presidential cycles? I think that's something that people should be talking about.
So actually, this is something that we found. So this is a Strategas chart.
So by the way,
repurposed.
Guy is not just a pretty face, right?
Yeah,
I know that there was a time that they cast him on Fast Money like 20 years ago because he was a good-looking guy. He's obviously very smart and he's witty too.
And I think he should be a caddy because you teed me up so perfectly.
Yeah, well, I'd be your caddy every day, any day of the week, sister.
Okay, so this is actually a Strategas chart that we repurposed for the column this week. But this is showing you just for the first year of an administration. And we're going to see charts like this all year about what happens in the first year and the second year and the third year and so on and so forth. But this is one that I actually found quite interesting. So in the first year of an administration, this basically shows sectors and their relative performance to the S&P. So anything above the line means that that particular sector outperformed the entire index. So you can see here a very clear winner. Financials seems to outperform, and this does not split it up by Democrat, Republican, or what the outcome was or any of that, but financials has outperformed more often than any other sector in the first year of a new administration. I bring that up because this is one of those instances where it seems like everybody's bullish on financials, right? And for good reason, right? We're expecting deregulatory environment. We think that a lot of CEOs and CFOs have been on hold as far as capital markets activity, including IPOs and M&A activity. Financials should benefit from that. We've maybe got a net interest margin benefit coming sooner rather than later. All kinds of stuff that could be a tailwind to financials. And then you start asking yourself as an investor, well, if everybody likes it, maybe I shouldn't like it now. Maybe it's a crowded trade. And you play this game with yourself. Sometimes it's just that simple. Sometimes don't overthink it, right? And financials have, in my opinion, they haven't yet experienced all of the upside that they could have since the election even occurred. They gave quite a bit back towards the end of the year. So this is one of those instances that all signs are pointing to at least have a presence in financials. You don't have to put your whole portfolio in it. You don't have to buy individual names and go full bull on one particular stock, but don't overthink it. And then the other thing that I found really interesting about this chart is that healthcare was the second best performing sector in the first year of a new administration. Now, keeping in mind, again, this has nothing to do with Democrats or Republicans winning. Usually you would think that there would be an effect, a pretty clear effect on healthcare, depending on the party. But healthcare is one of the sectors that Mario and I highlighted in the outlook as something that we really like for 2025. Partially because it was so unloved in 2024, which makes it more attractive from a valuation standpoint at a time when we are looking at valuations more closely. And because if investors are going to start to rotate out of tech, they've got a lot of gains in tech, they're going to look for growth somewhere else. And healthcare, particularly biotech and pharma, can be a source of that growth.
Yeah, really quickly, if Amanda can pull up the BKX, because this is an interesting one. So this is the banking index here at KBW, and it's a much better weighted ETF or sec. All right, so if you just want to look at this for a second, and I think it's pretty interesting that we talked about this a bunch. So obviously this was right out of the gate one of the biggest movers. I think it was up 10% on November 6th, the day after the election. And then it started grinding a little bit higher. But look at that move lower, right, into the second half of December, into early January or so. And it nearly filled in the gap. And now it hasn't made new highs. Now let's look at some of the biggest components. Let's pull up JP Morgan for a second. And then I want to go through the banks, because I think you make this point all the time. You use the term financials on a slide like that because you're just getting some broad exposure relative to other sectors, relative to the market. Nice consolidation after that gap, you break out. Let's pull up Citibank. This is a name that guy is liked, I think, for at least probably longer, but I'm just meaning from about a year or so as a valuation catch-up play. If she can put a 5-year chart on that, and I want to get guys take just purely from a technicals perspective, I know it still trades at less than 1 times book, which is one of the reasons why on a comparative level to JP Morgan at 2.2 or whatever. But you see this is getting back to a level from 21. And then let's just pull up Goldman Sachs, for instance. So this is more investment banking, obviously less. Money Center. Guy, these are really tough names to chase right here, right? If we want to pull up the BAC for a second, or GS, or one of those things, just to kind of show some other ones here. Thoughts there, because valuations are always cheap in the money centers unless you're JP Morgan. And then on the investment banks, they do get a little bit stretched there too. So thoughts?
Everything Elizabeth said is spot on, by the way, in terms of the sell-off they had and then the subsequent move back. And look, a lot of people getting very excited about the banks, probably last summer into the election, and maybe all for good reasons. Price to earnings being one of them. People were looking at historic norms and where they were trading, and they were trying to find things that potentially had upside that were still reasonably valued, and they found it in the banks. However, to your last point about not chasing here, yeah, I sort of agree with you. And so much of what she also talked about potentially be priced in. I think people understand the whole deregulation and the potential for M&A activity and IPOs and stuff. But, for example, JP Morgan at north of 2.5 times tangible book. I mean, it doesn't get much more expensive than that. I mean, you're talking to levels we last saw pre-financial crisis. And your earlier point about Citi, when it's one point at its trough, I think Citibank was trading about 62% of tangible book. It didn't make a lot of sense to me. I mean, Citi's got their issues, but one of the things that I said is, just a normalization, it's probably going to trade up to 80 and still it's not tangible book. And then the last reading suggests, maybe we have a little upside to 90, or if you want to sort of draw that horizontal line across the top. So, that's the way I come down on this thing. And I think we all agree that not all banks are created equal. If you are of the belief, like I am, that rates are going higher, I think Bank of America is going to have issues vis-a-vis their hold to maturity portfolio. But that's the lay of the land right now. There are a lot of things to like about them. There are a lot of reasons to think that maybe some of it's been priced in.
Yeah, no doubt. I want to get to this last slide, Liz, from your note, and maybe you can quickly explain why you look at factors. Okay, so this is the Russell 3000. It is basically what, 90-some% of the investable equity universe there. It's a 1-week factor performance. Again, it looks interesting, upper left, bottom right, but tell us what you're looking at and why these factors are important.
Yeah. So part of this, and this is something that I learned from a former colleague when I was at the Bank of New York, that it really is more about what's driving particular stock's performance than it is about breaking them up into sectors. Because when you break it up into sectors, as we know, there are some stocks that seem like they don't really belong in certain sectors, but they're still going to skew the index and that sector's performance. And then we know that there's weight issues in a lot of those sectors, and particularly those sector ETFs that can skew the performance. So the question then becomes, what are the driving forces behind certain stocks, and can you split the universe up into different buckets? This is a way to split it up into different buckets. So this is just a 1 week trailing look at what's happening in the Russell 3000, which is about as many stocks as we can get into a broad index, right? So over the last week, the momentum factor, so stocks that are driven more by short-term performance on the upside, has been driving the bus. And then next we've got the growth factor and then market cap. So this tells us again that we've probably gotten mega cap tech in the driver's seat, right? This chart looked completely different 2 weeks ago. And these factors can change pretty quickly, particularly the momentum factor, because just by nature, momentum is a short-term force in markets. So we look at these factors because it gives us a better gauge of what do investors actually care about at this moment, rather than are investors out there saying, I like Utes more than I like financials, and so on and so forth. Because I don't think that there are that many people, especially in the individual investor class, trying to split it up by sector, but they do care about this kind of stuff. And then the other big takeaway from this chart is that the classic defensive version of the market, so low volatility and dividends, not all that popular right now, or at least not in the last week. So this tells you again, the buyers are back, the risk appetite is back. And when things happen this quickly and you see reversals that happen this swiftly in the market, chances are it's going to move the other way before it can find a real durable uptrend.
Dan, are you familiar with the name Marilyn McCoo?
No.
Billy Davis Jr.?
No.
No. They sang a song together, and if Amanda were to slide the next slide, because it's a beautiful slide, and it illustrates the stars of Stargate. You don't have to be a star, baby, to be in my show. They sang that to each other, but apparently you have to invest a shitload of money to be in this show, and it's playing out right before our very eyes. And you look at like an ARM Holdings, for example, which is off to the races, obviously the huge move in Oracle, and this is all on the back of everything that transpired yesterday.
Yeah. So again, Trump hosted Masa Son. He is the CEO of SoftBank, which is, this large fund out of Japan, which gets most of its money from Saudi Arabia. Larry Ellison of Oracle was there. And that nice looking man right in the middle of this picture is Sam Altman. He is the founder of OpenAI. So these folks, they jackassed it to the White House and made some announcement about this $500 billion commitment to build out AI infrastructure here in the U.S. It's funny that this New York Times article suggests it's $100 billion. What I found most interesting about it is that all of these companies, they were all going to be spending this money anyway. They go down there to curry favor with Trump. They all talk about this investment's going to be made by the end of the Trump administration. So, I'm a little skeptical of this announcement as just kind of, a little bit of window dressing for what these companies were already set to do. But if you look at the stars of Stargate, you look at ARM Holdings, a chip company that SoftBank is an 88% holder of, so it's up 14% on the day. Oracle, which again is not a leader in AI infrastructure by any means, but happy to be part of this conversation, up 7%. Dell, that makes the servers that go into the data centers that train the models, now that's up 4.5%. That makes some sense to me. NVIDIA, that makes the high-end GPUs that go into the servers, that go into the data centers, that train the models. That makes some sense to me. And Microsoft, which, again, they have licensed OpenAI technology. They have a cloud deal with them. It's really server access, compute access. That finally joined the party, up 4%. And I guess this takes us, Liz, a little bit to that uncertainty you're talking about, getting back to core secular themes and the like. But this is the sort of stuff that we are likely to hear a lot about, like in the early days of the administration, and then they probably peter out a bit.
Yeah, I mean, the conversation is obviously not going away, but the third risk that I did not mention before when I talked about the risks to our 2025 outlook, the third one that we have listed is AI fails to be monetized and earnings disappoint. Now, that's not me saying that that's what's going to happen, but that is a real risk here. And when you see reactions in the market like this on an announcement, and maybe you're right, I don't know enough about each particular company and what their plans were, but when you see announcements like this, that if you're correct, Dan, were already existing and it was just kind of like putting it all together with a different phrase, and you've got a market reaction like this, that would say to me, okay, we're running the risk even further now that if this doesn't materialize the way that investors are clearly expecting it to, we have to reprice that out of the market. So when we look at just the AI landscape in general, and this is another reason why I talked more about software than I did about semiconductors in the outlook, there's a lot of risk in it. The expectations are high. And the bar is really, really high after the last couple years. And it's going to be hard for companies to not only beat those expectations, but continue to raise guidance at the clip that they have been. So I think that there is a risk to sentiment broadly from the AI theme because of how much optimism it continues to get priced into it.
Dan, what's that saying when you throw cold water on somebody's excitement? What do they say? You throw
Rain on a parade,
or throwing cold water.
Yeah, that too. But
too. Well, it appears as though when Elon Musk is throwing a little cold water on things, because he has come out and basically says they don't actually
it's amazing.
have the money. Now, I'm not laughing. I guess I am. I am laughing. No, but one of the concerns I have around a lot of different things, but specifically around Tesla, but I'll let you opine on this. I think at some point he is going to wear out his welcome. And if he continues to sort of capture the media spotlight, historically, those universes tend not to work well together. And, you go through history, now President Trump, I mean, a lot of people that he's become enamored with, he could just as easily become unenamored with. And I think to a certain extent, it's not if that happens with Elon Musk, it's when. And when you see things like this, I think the timeline gets sped up.
Yeah, this was almost immediate, right? One of the main issues here is that, Musk went to, look at that. That's some of the new equipment that we have there. Jacob's in the office.
What happened?
That was amazing. Did you check that out? We have some new cameras. Hey, go in the chat and tell us, do you think we look a bit more clear? Because I think it's
Can you
Jacob's
see my
doing
pores yet?
Yeah, Jacob's doing so. I will tell you this. My hair, which is obviously salt and pepper, if you're anywhere near me, the lighting before we got these new cameras, it was really dark. It was hard to tell. You know what I mean? And now I think it's a bit clearer for whatever that's worth. But I thought it was really interesting because, again, Musk helped found OpenAI. It was meant to be a nonprofit. He left. Now they are suing each other. Like, he's super pissed off. He started his own competing company. And I just thought that was amazing that immediately, you know what I mean? Like, he starts tweeting this. So it'll be interesting to see what Trump has to say about some of this when he's undercutting a big supposed announcement like that. Guy, Wednesday's not only exciting on the market call because we have Liz here in the studio with us, but there's another reason that you become very fond of Wednesdays on the market call.
Well, Johnny Nash, you were just saying how you could see clearly now. Well, Johnny Nash obviously saying, I can see clearly now, the rain is gone. But every Wednesday, we're all allowed to see a bit clearer because we are, I don't know what's the word I'm looking for, privileged to have the work of John Butters. Of course, John Butters being the senior earnings analyst at FactSet, and somebody that we've really grown just to adore, has our audience, by the way.
You are yearning for that senior earnings insight analyst report that drops in your email box every Friday morning. You can get it there at factset.com/insight/subscribe. Now, Guy, you and I mention this all the time. I know Liz loves being here on Wednesdays too, because I think a lot of Butters' work really helps kind of put some context around what we're talking about. Earnings season, it comes 4 times a year. For most of the S&P 500, it's kind of bracketed within a couple weeks or so. But John does a great job of highlighting a lot of these key themes throughout the quarter, which means all year long. This one is interesting in earnings season in particular, right? So what are some of the factors, Liz, that move stocks in and around earnings? Is profitability, right? And so when companies are doing things to increase profitability, that means they're doing stuff to increase their profit margins, right? And so we don't have to get in the reasons for that. I think if you guys watch every day or listen to us, you get that. Let's talk about what John's looking at this week. The blended, which includes actuals and estimates, net profit margin for the S&P 500 for Q4 2024 is 12.1%. This marks the third quarter that the index is reporting a net profit margin above 12%. So if I just take that, it would be helpful if we were basically, comparing this, routinely, but 3 consecutive quarters of 12% plus. Pretty good. It kind of endorses maybe those few turns in the market multiple that have happened through multiple expansion, right? When you have, margin expansion, that means multiple expansion. Liz, talk to us about this, because again, if we start to see this accelerate, or at least make more consistent, quarters in a row, that will justify a stock market to increasingly rise, even if it's expensive.
Yes, it will. And some of the math of this too, and I don't want to get too weedy without diagrams to show it to people, but some of the math of this too, if you've got profit margins that continue to expand, chances are the bottom line is also expanding. So you've got solid earnings growth. If earnings growth comes in as expected this year, which I believe is right now somewhere between like 13 and 14% growth, earnings growth could outpace the growth of the index, which mathematically would actually reduce the multiple. And even if we kept the multiple the same as it is right now, you still could see about 10 to 11% upside in the index if earnings growth comes in. So I say that all because a lot of times when you have extended valuations, or people talk about frothy valuations, things are high. We had that table before showing how extended things were on a percentile basis. If you can justify why they're extended, they have more opportunity to stay there longer. That doesn't necessarily make it entirely rational. It still may be at an extreme, but there's no reason for it to turn back around because there are fundamentals supporting it. So if we continue to see profit margins either stay strong or even expand from here, I think there's a chance that multiples stay extended for a longer period of time, even if we think that we're paying too much for some of those stocks. So we have to keep that in mind. The other thing I would say about profit margins is if you look back, and you can see it on Butter's chart here, back in, I think it was Q2 2021, they hit a high of 13%. Okay. So we're down from that. We're getting closer to the sort of upward trend in profit margins where it would be a normal profit margin trend growth level. In which case you don't feel like things are all that extended if it stays sort of at this pace. So this is kind of the level that I think is comfortable at these valuations, but we have to maintain it. And that continues to be the key. You have to maintain this sort of profit margin. Things have to stay this strong in order to justify the price multiple that we're at.
It's interesting. I think one of the hopes of AI is it obviously adds to exactly this, margins, right? AI sort of is a margin enhancer potentially. And I think to a certain extent, there's a notion that margins can continue this trajectory higher on the back of that. That remains to be seen. But, if you had asked me prior to seeing this, what group would have led the way on this, there's no way, Dan, I would have said real estate. So I'd love to dig into that. I would have said probably information technology, because that's been basically number one on all the work that John has done over the last year and a half. But, what's fascinating about this is that is head and shoulders above everything else. And to a certain extent, you wonder if that skew remains, or, what was sort of the variable on the back of that. So that's the one that obviously sticks out to me.
Yeah, this is work that John's been highlighting, I think, for the last couple of months or so. So the 6 sectors are reporting a year-over-year increase in net profit margins led by financials. I think that to some degree, what you're talking about are REITs that probably fall in there. 4 sectors are reporting a year-over-year decrease in net profit margins led by the energy sector. Also something that Butters has been talking about, and Guy, and you and I have kind of hit on. So again, it's always good to kind of drill down on some of those sectors. Guy, we got 2 things to do before we get out of here. One will be the calls of the day. And let's look at Netflix. Again, we highlighted that when we started out here a little bit. So it got 3 upgrades this morning: Canaccord, Rosenblatt, Benchmark, and Barclays. 4, I could do that math. And you know why? I mean, we've been talking about it over the last day or so, what was expected, right? The subscriber number was just lights out. The profitability, again, this is on the heels of what, Butters is just talking about, has been very good. We've seen margins expand from about 40% 4 years ago to nearing 47.5 now, expected to go higher. They're just running away in this category. So if you look at this chart, Guy, we see the pullback that you thought was buyable into the print. It really has had very, I don't know if you want to call them orderly sell-offs over the last year or so. What do you do with a stock like this that has this sort of 2-day move? It kisses 1,000, which is a nice round number. It's down a little bit from those highs. Kind of hard to chase, despite the fact that that was a great quarter.
Yeah, a remarkable quarter. And it's one of the things you said last night on Fast Money, their price hikes, those dollars go right to the bottom line. So that's a margin enhancer without question. And people got excited about it. We did yesterday think that the recent sell-off set up the stock to have a move. I'm not going to say I thought it was going to $1,000, but, I thought it could have a bit of a bounce, and here we are. So how do you trade it today? Well, pull up that prior slide. You think the average price target is 980. We're basically trading right around there-ish. The high in the street is 1210. What I said last night on Fast Money, what I'll say here is, if you have not been in the stock, I think the first logical level of support comes in the form of the prior all-time high, which is about 940-ish. So I would look for a move back down to there, and then we can start having conversations. But with all that said, all we saw yesterday was just basically proof positive and a reinforcement of the fact that it's Netflix world and everybody else is just residing in it because they are dominating the space. And, you said it last night, their competition is seemingly sleep. I think YouTube has probably found its way into the conversation, but, people having to sleep is what the competition that Netflix seemingly has.
Yeah, no doubt. And it's not just the price hikes that are helping those margins. It's also this change towards, getting rid of, I guess, password sharing. And then their advertising business is growing very fast. So their ad supported model is really good for margins. Also, so that's the story on Netflix. I don't think you and I are chasing that one. I just want to get one last chart of the day here. This is in Seagate. This is not a company that we talk a whole heck of a lot about. They make hard disk drives that go into servers and PCs and the like, and they had better than expected margins and were able to beat and guide higher. And you see that gap there. I just want to go to a longer term chart here. Well, let's go to the 1 year. Look at that move, over the last week or so. So again, a tough one to chase. It trades cheap on valuation, 15 times this year, 11 times next. You don't find too many names in the tech sector. A bunch of their big customers are the server makers, right? Dell and Hewlett and Lenovo and the like here. So you see that. You want to pay attention to that as we get deeper into earnings season. Really quickly, though, this 5-year chart, I think, is the one to keep an eye on. That's a log chart. You see that it just bounced off that uptrend. It's through the 150-day moving average. It's approaching that prior all-time high in 22. So again, this is one not chasing. Guy, so we had Butters. We know where to find his earnings insight analysis. Liz's weekly.
A little more confusing. A lot of dashes.
We got a preview of it.
And
it's obviously great work. SoFi.com/on-the-money. Or you can just go to the SoFi blog and you'll find it there, Liz.
It's very easy to find. You can find it in so many places.
Yeah.
It's too easy.
One can do that. Guy Adami.
We'll put it in the show notes.
Yeah, great. We'll put it all in the show notes. Drop a mention in our chat if you like the new lighting, if you like our advertisement for B&H, photography stuff and everything. You guys could thank Jacob.
B&H, those are the guys. They're on 9th Avenue and 34th Street.
They're closed on Saturdays. Yeah. All right. Listen, we appreciate y'all being here. We will see.
Hold on a second.
What?
Elizabeth earlier said that you want to have a presence in the financials. Did you use that word?
I did. I believe I did.
Of course, Presence, by the way, the 7th studio album from Led Zeppelin.
Yeah.
I think it's probably not one of their better albums, but and anything Zeppelin is a good thing. Nobody's Fault But Mine, I think, is the song that sort of resonates with a lot of people. And I'll say this, most of the time it is nobody's fault but mine, Elizabeth.
Matter of fact. All right,
at
Liz.
least you can take accountability for that.
Yeah.
I applaud you.
All right, guy, we got other podcasts to do here, buddy.
Oh,
So
I
appreciate
apologize.
Hey, two things I just want to kind of highlight. Guy and I are sitting down with Mike Wilson from Morgan Stanley tomorrow. That's going to be a drop on Friday, the On the Tape podcast. Also, I'm about ready to sit down with Tommy Vitor of Pod Save America.
Wait a second. Tommy Vitor, the guy that was on
Colbert the other night.
Colbert
We're
the
going
other
to
night.
talk about a lot of these kind of policy changes and what that might mean for the economy and the markets. That drops tomorrow on the On the Tape podcast feed. Check it all out. Thanks for being here, Guy
You know what
Adami.
my grandmother used to say?
Young
Little guy, he's smart as a whip. I don't
Yeah.
know what that means. Elizabeth, maybe.
I
We'll talk
don't
about it tomorrow, but Tommy Vitor, smart as a whip.
All right, people. Thanks for being here.